This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.
Well, good evening, everyone. This is AJ Monty, Chief Market Strategist with the Market Guys. It is now 8 p.m. Eastern Standard Time, and I hope all of you had a chance to watch that lunar eclipse last night. That was absolutely incredible. And my son, who grabbed my photography equipment, got some really amazing photographs of the moon as it was turning its blood red color right around midnight, or a little after midnight last night. And it's one of those things that you just, if you had a chance, you just go outside. It was a little chilly. Even down here in Florida, we had to put our coats on, and we just did a little stargazing. And as we were watching the moon, a lot of the meteorites and comets, or whatever they're called, the meteorites, the shooting stars, were just going like crazy, and just absolutely incredible. But to tie that into the market, it looks like we're about to face a red moon here in the markets. You know, if you've been following along with my weekly market report, you'll know that I pay very close attention to the color of the candles. And I did say that we had a stretch right here of 7 green candles in a row, and that was the longest that we've had all year. Now, I'd like to point your attention to these 2 candles right here. If you could see those, they look like dojis. Well, if on this day right here we closed a penny higher, and this day if we closed 2 pennies higher, it would have been 11 candles in a row, all green. So that is a significant, what we call a stale green light, and I am anticipating that we're going to be pulling back this week with some red candles, pulling back from this resistance area, which I'll get to in a little bit. Another thing I want to point out, if you got to see this on Google or Yahoo Finance, the IMF came out with a report out of Davos, Switzerland. And a couple of years ago, I was in the Steigenberger right after the economic forum took place, and I had a chance to meet with some of the leaders there. Just a beautiful place in Davos, Switzerland. And you know, as I'm going through this report, I want to point some things out. The IMF is basically projecting the global outlook to be 3.5% this year, all right, and only accelerate to 3.6 in 2020. Now, if you are really savvy with regard to the global economies, and believe me, I'm not trying to pose as an economist by any stretch. I look at numbers, I crunch the numbers, I pay very close to trends and such. But right now, what we're seeing with the trade war with China is actually, as I'm looking at it, not going to affect the U.S. all that much. And I could prove that to you by looking at the Dow. All right, I'm going to do that in a minute. The world relies on the American buyer. We buy so much from the international markets, whether it be, you know, perfumes from France, or you know, goods from China, or cars from Korea. We spend a lot of our income on products that are more or less manufactured outside of the U.S. So these tariffs, while it might put some pressure on certain sectors, the U.S. economy is going to continue to thrive, I believe. And here's how I'm going to prove it to you. If you look at the Dow, all right, we're still going up. Now, I don't want this to be a mixed message, but the Dow Jones Industrial Average generally leads the U.S. economy. That's what Dow theory is all about. When Charles Dow more or less created his Dow Jones Industrial Average, he was looking at the companies that were driving the American markets. And right now, we're coming off of these lows, and it's going against what I projected, but I'm reading the charts to you. Until we see a complete breakdown of this overall trend, that's why this week is going to be critical for us. And I pointed this out on the weekly chart a couple of weeks ago. Let me go to the weekly chart here. This is the 3-year movement of the Dow, and here is the 20-year trend of the Dow. And from 2009, right at the beginning of 2009, after the crash of 2008, technically, and don't believe what you're saying about bear markets, and bear markets are short term when they're defined, but if you look at the longer term trend here, we're still in a significant upward trend. Now, when I talked about what I called the kiss of death, and let me refer to that as the point at which the market makes an attempt to get back up over this accelerated trend line right here. See, I call this the Trump effect, right? From 2016, when President Trump got elected, the markets took on a whole new level of optimism and rallied up and accelerated the growth from an existing upward trend. You see what I'm getting at here? Let me just take one step back so you can see the whole trend. So this trend line is still intact, and I believe it will stay intact. Now, for the short-term buyers or even the short-term sellers, there is the possibility that we will fail to get back up over this former accelerated trend line, and we could drop in a big way, but that doesn't mean the U.S. economy is going to fail. I think we can pull back, yes. But I think that this overall long-term trend is going to hold. And this is more or less our safety net here. So what does that mean? Breaking this down, the short-term buyers have to be very, very cautious. The option traders should still consider bearish strategies going out a month or two. And that's okay because you can make money on the way down. The long-term investor needs to be defensive to defend against a short-term pullback, but overall, I think everyone would be in great shape if we created some new buying power so that if over the course of 2019 we pull back here, we can still participate and buy at bargain prices down at these levels that I'm circling. Hopefully you can see my cursor right there. You see, this is a bearish engulfing pattern. This is a bearish engulfing pattern. We tested last month in December. It looked like everything was going down quickly, right? And then we had this long shadow. We had this green candle. So getting back to my weekly chart, we have to be very mindful of this possible pullback. And I think we will pull back. This coming week, I think we'll pull back. We have a weekly chart. We have 4 green candles in a row. The last time we had a stretch was back here where we had 6 green candles in a row. See back here? But it wasn't as steep in the angle that we're seeing here. This is almost vertical growth in the past, 4 weeks. And if you go back, you'll see that we go through these cycles of rallying, pulling back, rallying, pulling back again. And so there's a lot of opportunity for all of us to participate, whether you're an equity trader or an option trader. Now, before I get on to the other markets, I just want to point something out to all of our equity and option Oracle subscribers. A week and a half ago, 2 weeks ago, I put out a buy alert on Ford, all right? And we bought, and we did really well. The option traders wound up making about 33% on their trade in just about 1 week. The equity traders, if you got out when I told you to get out, you made about 9% in that 1 week. And what happened, it was like the day after my sell alert went out, Ford dropped, and we went through a very quick retracement. Now, look at the distance from this low to this high. If I were to go, I'm just showing you the power of technical analysis, particularly Fibonacci retracements. If I go and add a study, or if I actually, I would have to do that through the drawings. If I put a Fibonacci retracement on here, and where is it? It's right here. I go to the Fibonacci retracement, and I go from this low right here, which is, see this pullback here is the support level. I go from that low to this high right there. Look at where Ford pulled back. Again, after I put the sell alert out, look where we pulled back, right to the 50% retracement on the Fibonacci scale. See how powerful that is? And if you go back, and even if I delete all these lines and I go back a little bit further, I want to show you, if you're not using Fibonacci retracements as a tool for more or less gathering your price targets, or at least estimating your price targets and pullbacks, watch this. Take from this low, and I'm going to go to this high right here. See this doji up here? I'm going to go from this low to this high. And look, where did the market pull back? Right to the 50% Fibonacci number. See how powerful that is? On the way down, let me just show you how to use this. If you've never used Fibonacci retracements, experiment with this on your own platform. On the way down, if I'm looking for a bounce and I see, okay, the Fibonacci, I'm starting from this high and I'm going to go all the way down to this low right here. Where am I estimating on a bounce? Where am I estimating at least 50%? And it recovered 50% and went all the way up to this level right here, which is a 78.9%. That's the 78.6% Fibonacci retracement, and then it pulled back. You see, so if you're looking for a tool to more or less guide you to where price targets could be, especially when we have extreme moves, then I would encourage you to explore the Fibonacci retracements. I don't recall, have to check with Kenny, who's our technical guy on the website. I'm going to see if we have one on Fibonacci retracements. If not, I'll do a video on that to show you how to use it. All right, but that's just on Ford. VSTO, again, I'm just talking about some of the trades that we've had. VSTO, we had a long position in VSTO. It's been making a nice recovery right here. I think we're seeing more or less a cup and handle right here. This one could go a little bit higher. It didn't sell off all that much even after stochastics cross. That's actually a sign of strength. If you see a sell signal on stochastics, but the stock just kind of hovers in a sideways movement, that's a sign of strength. All right, so keep an eye on that one for the Oracle subscribers. And if you are not yet subscribed to any one of our trade alert services, I'm inviting you to do that for at least 1 month. I mean, it doesn't cost all that much. Try it out for 1 month. I'll give you 4 trades in 1 month, and if you don't make your money back in at least one of those trades, then you know it's a month by month. We don't lock anyone in. It's very inexpensive, and my goal is to make more money for you with the trade alerts than what you're paying for the service itself. So I'm just throwing that out there at the beginning. All right, let's go to the Russell 2000. I'm going to move right along. This is a 1-year daily candle chart. The Russell 2000, as you can see, has gone in a pretty extreme upward move, and we are at a role reversal resistance area. What I'm going to do is I'm going to use the Fibonacci retracements to start at that low, and I'm going to drop it right from Friday's high. Now, notice my pullback line. See my target? Now, I did this by eye last week, but notice where my target price is. Very, very close to 50% on the pullback scale right here for the Fibonacci retracement numbers. You see that? I also forecasted, let me get rid of that, remove that drawing. I don't want to remove, okay. I don't want to remove my forecast because I leave those there. But the other thing I forecasted was that the stochastic would cross. The blue line is the percent K. That's the formula that measures the momentum or the change in momentum. The blue line, if you're new to stochastics, is a 3-day period moving average of the K line. So if we get across below the D line, that red line, that is a sell signal for traders. Now, if you look back, I'm going to point this out to you. Notice that during the course of the last year, there were only a handful of times when the K line and the D line were above 80. You see that? Here, let me give you an example. Here, the K line was over 80, but not the D line. You see that? So the K line got overextended, overbought. Here it got overbought, but back here, notice what happened. The K line and the D line were overbought, and it crossed right there. Look at that, 5 days before this massive sell-off here. You see that? Back here, again, the K and the D were above 80 on that scale, both overbought. It crossed. Look at that, 2 days before this sell-off. And it doesn't look like much of a sell-off, but that's a pretty significant sell-off in the Russell 2000 right there. So look, what do we have? We have the K and the D overbought. So the moving average is overbought as well. I'm forecasting that they're going to cross and go down. And we could see a 50% retracement from this upward leg right there. Now, I'm sure Jeff is listening to me. Jeff has been very critical over the past couple of weeks, and I appreciate that. He's keeping me honest. Last week, I went on a limb. I'm sorry, the week before that, I went out on a limb, and I said there was a 99.9% chance that the markets would sell off. Guess what? The 0.01% hit, and we didn't sell off. But in turn, we became even more overextended to the upside than we were the previous week. So this week, the odds, again, are in favor of a possible sell-off. And you combine that with the news at the IMF, I mean, the futures markets were down when that article came out. I don't know what kind of pressure we're going to see tomorrow morning before the opening, but I don't think it's going to be where all the buyers are going to just rush in, you know, this coming week. It's a short trading week after Martin Luther King Day today, markets being closed. We now only have 4 days for those traders to get their profits in and make their trades. So we're going to see more volatility. I also made mention that the week after the monthly expiration of the options, the week after that is usually the most volatile of the month or the 4-week period prior. So keep an eye on that. We have everything kind of pegging into this picture of higher volatility this week with the signals pointing lower. Why? The S&P 500, we back up a little bit. There we go. All right, now look at this resistance area right here. Same scenario as what we saw in the Russell 2000. We're at a resistance point here. We have a long stretch of green candles. We have the stochastics, both the K and the D, overextended and getting ready to cross. And we have a higher volume. Now, I pointed this out. I'm looking for a drop in volume tomorrow morning, which would signal the drop in buying activity. With the spiders, my forecast was that we might see a slightly higher day tomorrow. I don't think we're going to break out of this, but I think we can carry some of that momentum because the volume was increasing right there. We have 1, 2, 3, 4, 5, 6, 7, 8 green candles in a row. We might even show up with a doji tomorrow with a higher high than last Friday. We could even see a red candle tomorrow with a higher high, higher low. Understand that the red candle could still show up and still have a higher high than we had on Friday. All right? There's many times. Here, look. Here is a red candle up here. Can you see where my cursor is? That was a gap up. Higher high, higher low from the previous trading day, but it's a red candle. Why? Because the market opened at the top of the body, closed lower than the opening, and that's why you get a color red. You could still have a higher market, but have a red candle there. So keep an eye on that as well. Now, if we go to the VIX, which is inversely related to the S&P right here, all right, we had a doji on Friday. Very unusual that you see dojis on the VIX. We have a doji after the cross right here. The cross occurred on Wednesday, Thursday right here. And I'm forecasting, I left this forecast line. I think that the VIX stochastics are going to start going up. I left this line in place with the end of the line being my target for the VIX. If the VIX goes up, the S&P will drop. Watch. Let's see where this Fibonacci on the downside brings us to the bottom of the line. Look at that. My end of my target brings us to 38.2, precisely to a Fibonacci target area right there. So I'm going to leave that in place. Let me clear that. Oh, I don't want to clear all the drawings. I just want to clear the Fibonacci's. Okay, there we go. All right, moving on to the Qs. Last week, Tesla and Netflix had tough trading sessions. I still think that the VIX, the Qs are going to go up a little bit, even though it'll be a red candle. I think we'll see a higher high. Why? Because we had increased volume on Friday. I think we'll see a higher high carrying that momentum as we hit resistance, probably lower volume tomorrow as the stochastics cross once again. What did I leave out? I did the diamonds, Russell 2000, the Qs, the spiders, and lastly is the VIX. I think we did that with the doji. So we're covering all of the bases right there. I would suggest that if you are, again, trading the short term, try not to marry your positions, all right? In other words, what I would do is you look at the markets, look at the technicals, be sure that you are ready to get out at a moment's notice. Don't just hang in there and hope that, it's just going to work in your favor. If this thing turns down and starts correcting to the downside, even though the long-term trend would still be intact from 2009, we could still see downward pressure, and you don't want to be holding on to long positions when the sellers have taken control over the price in that short-term period. All right, so that's a quick review. Let me do this. Let me go now. I'm going to see if there's any questions there. Hey, where's my Q&A box? Oh, there it is. I have to open this up. All right, now let's see. We have any questions coming in? No questions. All right, now I'm going to queue you up. Let's see if you have stock symbols. Stephen is looking at Lulu, ticker symbol LULU. Let's take a look at that. And if you could, please make sure that you're giving me either what your position is or what your intentions are for the stock that you're giving me. All right, Stephen. So if you could put that in, that would be good. All right. Now James asked a question about the stochastics, and he asks, what settings are you using on stochastics? So I'm using the default settings, Stephen. I'm sorry, that's James. James, I am using a 14-day period, so that's what it defaults to, and I'm using the %D as a 3-period moving average. So if you don't have it set to that, I would change it to make it look a little bit easier to read. And by the way, I'm using slow stochastic. I'm not using fast stochastic. Fast stochastics a lot of times is more erratic. They'll give you more false signals, and you could get whipsawed on the fast stochastics. If you're a day trader, you might use fast stochastics, but for the swing trader, I recommend the slow stochastic reading on that. All right, so hopefully it helped you out. All right, let's see. Stephen, answer me on that. Okay, you're a runaway up. Let me see. Runaway upward gains past few weeks, anticipating a correction. Well, I would agree with you on that. All right, now, Stephen, if you look, this stock has gone up in a more dramatic angle here. Oh, let me get rid of that. I don't want Fibonacci's. Let me get rid of that. Let me switch to a regular trend line here. I'm just going to draw a diagonal trend line. Now, I want to show you something here. This is, I guess you could say, this is the longer-term trend from that low to this low that we see here, all right, on December 24th. Now, I'm going to review the construction of what we call fan lines. Fan lines are nothing more than you're tracking the next accelerated trend. So here is the overall trend. I could even go so far and back up a bit and probably go to a weekly chart and find another trend here. See, if I go from here to here and project out, you see there's first trend. Let me do this one here. Let me redo this. Then I could take the last low on that line, connect it to this low and project out. There's fan line 2. All right, now I could zoom in to the daily chart. You see, now we have 2 accelerated fans. Now I'm taking the last point on that trend, connecting it to that low and these lows here. So I'm projecting that right there. There's accelerated fan 3. And if I zoom in a little bit more, I could even go so far, actually, boom, and I could even do this. You see this? So generally, okay, just so you know, Stephen, I'm sorry, I keep saying Stephen because, yeah, it is Stephen. All right, good, Lulu. And usually after you see 3 accelerated fan lines, it's already overextended. So here's 1, here's 2, here's 3. We now have 5 accelerated, and I do not believe that you're going to get anything more vertical than what we have seen already. So I totally believe that what you're saying is true. It's completely overextended. I would forecast, and I'm going to do this. I'm going to say that this stock is probably going to do this to fill this gap here. And then after the gap fills, it's probably going to do that. Now, notice what happened. This is very unusual. You had a sell signal back here when it was overextended and overbought. It pulled back a little bit, and then it crossed back up over it. Very, very unusual, right? So if you're long this, the best thing to do is to actually trail your stop with a stop maybe below Friday's low or maybe below Thursday's low, and then just be thankful that you're capturing profits if you have it. Now, if you're looking to get back in, if let's say you've sold out or you're going to sell out, it wouldn't be out of the question to wait for a bounce in this area, get back in right on that bounce off the gap, and then put your stop right below the gap fill point. That's the way you would trade it. But I totally agree. I think it's overextended. It might even be a short candidate. Now, before you do that, you want to check the news, make sure the company's not initiating any kind of a buyback plan where it could push the prices even, over 165, these highs. Just be careful of that. Watch for the volume. And the option traders, if there's options traded on this one, let's see, are there options? I don't see options here. Yeah, there are options. Look at that. I'm going to have to look at that. That's a nice candidate for a possible credit spread, call spread, or a diagonal put spread. That one looks really good for a downside. Again, Stephen, I don't know if you're an option trader, but you might want to consider that one as well. All righty. Now, let's go. Ron is looking at SBLK. What would be a good entry point is Ron's question. So let's go SBLK, and that is Star Bulk Carriers. Well, from the looks of this, right now, Ron, again, you have to weigh in all of the evidence that I talked about with the general markets, right? Because a lot of times, even if a stock is getting ready to rally, the general market or a sell-off in the general market could put pressure on those particular stocks. Now, what we see back here is more or less a double bottom right here. So it's bounced off the double bottom, and it looks like it's trying to get over this resistance. Now, you could also look at this as more or less a complex cup and handle pattern here as well. I'm actually doing a presentation for Investitute to cover cup and handle patterns. But if you get a breakout over that high on higher volume, that would be an entry point, right? That would be a good entry point on a breakout over that high, and then form a resistance once broken. So let's say it does break, form a resistance once broken, then turns into support. We call that role reversal. So if you do get a breakout over here, you would put your stop just below the breakout point, and then as the stock moves higher, you would trail your stop. The percent K is starting to turn up, so the momentum is higher, but it was not turning up from an oversold condition. This is telling us that the momentum is still going higher, but it's not at an extreme, low point. So be really careful to trail your stop up with that. All right, got a lot of stocks symbols pouring in here. All right, so Bill has a question. What's your take on Air Canada? got in at 750 and have been selling at highs and buying back lows. I don't think I have Air Canada on this platform. I think it's only U.S. stocks. AC comes up as Associated Capital Group. Bill, I'm sorry to say, but here's the thing, right? We have a mixed bag, and this will affect Air Canada as well. Let me just look at JBLU was one of the stock symbols that we put out as a buy recommendation a while ago, and you can see that JetBlue is doing very well. If, by the way, you are a subscriber and you bought into this when I put the trade alert out, make sure you're trailing your stop on this one as well. The volume dropped on Friday, so you're very close to taking your profits here. You're at a resistance. Now, let me just give you the technical signals. If you look at most airline stocks, and that would include Air Canada, Bill, you have short-term upward momentum. And a lot of that is in anticipation of strong earnings because of the cheaper oil prices on a global scale, particularly in the U.S. Airlines are really enjoying the lower oil prices and gas prices. FedEx is another one, even though they're a carrier company. However, this temporary government shutdown could actually deter travelers from taking a flight to go see their relatives for Valentine's Day or whatever it may be. A lot of people, including myself, would rather fly private and instead of going on commercial, because I don't think I want to deal with the long lines at security. Now, again, I have different scenario. I use Clear Card to cut ahead in the lines, getting preferred treatment because I pay for that membership and all that. So I won't have to worry about that too much. But the average traveler might have to really spend a lot of time waiting for security to clear them. And if TSA is not showing up for work that day, that could put a damper on the the profits for a lot of these airlines. So you have to weigh that in. Right now, I would say if you got in at 7.5, I don't know where it's trading right now, but if you're seeing a drop in volume, particularly tomorrow, there's an old saying, and I told John Cothran this last week, you can't lose money taking profits. All right, so I think this is a great time to be taking profits in any stocks that you have, particularly with the way the signals are reading on the general markets. All right, so keep an eye on that. All right, thank you for that. And Rick is looking at GOLD. All right, now this, let me see, why am I GOLD? GOLD, there we go. That's the new symbol for Barrick Gold, if you're not aware of that. And Rick, you're not really telling me what your position is, but you can see that gold has sold off. There is a slight gap. See this? This is important because gaps fill about 80% of the time. There you go. It's filled. It filled as of last week, either Thursday, Wednesday, or Friday. It filled. There's a small gap right there. There is a good chance that you'll see a bounce on the technicals because 80% of the time after a gap fills, it reverses. And you can see down here, the stochastics, the percent K and the percent D are in the oversold territory below 20, and they're getting ready to cross. All right. Just so you know, I had sold out of my silver position entirely a few weeks ago, and I am looking to get back in. I think even silver and gold, both the precious metals and the miners, are looking pretty good because they don't always follow the general markets. In fact, on the contrary, you have people who might be a little skittish or shy, to get into the Dow at this particular point, but they feel that the precious metals and the miners especially may be a better safe haven. So it becomes more attractive. That's the only time that I would consider getting long in a down market is when you're looking at the contrarian stocks that tend to work inversely to the general market. So It's not always the case, but in this case, that would be a good look, at least. All right, let's see. Moving along, we got GOLD and D. McLean is PTLA. Let's take a look at that. PT, you own it at 24.60. So PT, why isn't it going in? Hold on. PTLA. All right, there we go. Wow, look at that stretch of green. I mean, immediately my mind is telling me sell it, but let's look at this first. All right, so you own this one at 24.62, and you want to buy more. All right, I get that. It's treating you well, and a lot of times you want to buy into strength. However, let's count the green candles. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 green candles in a row. Volume is off a bit. It was up on Friday, but overall, it's off from the highs back here. You have the stochastics crossing, and you have a gap down below the market. Now, here's what I would do. Now, I'm just telling you, if I own this stock right now, I'd be putting a stop right below Friday's low, and then I would wait for the gap to fill before getting in, anticipating a bounce at that particular point. That's what I would do, right? Now, that's an impressive upward stretch right here. This is an upward leg that looks like it won't quit, right? But let's take a step back. Let's look at the weekly chart. Here's a double low down here. That looked bullish, okay? This is a weekly chart now. You have 1, 2, 3, 4 weeks in a row, all right? And on the weekly chart, you have resistance up here at around 30. So I think what you could see is a great opportunity to trade this one in a pretty wide trading range. I mean, that would be a $15 wide trading range right there. If you're not so thrilled about the idea of selling your position, maybe you could, if you know anything about options, maybe you could read a little bit about options and consider maybe selling some covered calls. You know, if you want to look at the February options, here's the stock trading 26, but you could sell the $30 calls and take in maybe 70 cents on that. You sell the 30 calls, they're basically paying you 70 cents a share to sell it to them $3.50 higher. You know, so that's something to look at. If you don't want to sell the position, you could maybe sell an option to take in more cash. That's something that you can consider. But right now, looking a little overextended, possible pullback in the works, and a gap below the market. So be careful about that one. All right, Phil is looking at Tiffany and Company. No position, he says. All right, so it's TIF is the ticker symbol there. Now, interestingly enough, this is a gap up on Friday. And so if you don't have a position, you're kind of caught in the middle of these two gaps, Phil, right? So you have a support level down here, which is pretty far down below the market. I mean, it's trading almost $90, and that support level is around 72. So that's a long way to drop before you find support. There's a gap down here. The volume is high. It looks like news may have come out, and there's a gap above the market. So you're caught between two gaps. Gaps act as price magnets. So while this gap might seem very attractive and bring you up, could bring you up another $15 or so, there's still a gap below the market. This is a tough one to call, because if you are thinking about buying it, then you would have to put a very tight stop below this low right here, which would give you 81, like a stop right around 81. So you're kind of risking almost $8 to almost $9 actually. Almost $9 to get into that one. That's 10% risk per share on that one. So again, I think you can find better positions to get into at a cheaper price. But I'm not going to try to talk you out of it, because with the increase in volume, it could make a move higher before pulling back. It's just that so when I'm looking for trades, I'm looking for trades that are more or less stocks that have been under pressure, like CME, for instance, all right, Chipotle Mexican Grill, right, CMG rather. CMG, you've heard about, you know, how some of their patrons have had food poisoning, right? Well, no one died. I know that sounds almost callous, but any restaurant that you've heard about, at least at one point, they've experienced, you know, Ebola or, you know, some kind of E. coli and having some kind of a food poisoning incident. Restaurants recover from that. So when I see a stock like CMG under pressure, I wait for the news to subside a little bit, and I try to look at the indicators, and I look when there's buy signals, and I try to trade the extreme price movements towards the middle. This one, the stock is in the middle of the trading channel. It's smack dab right in the middle. So I said before, this the support level is right around 70, 72, 73, with the resistance up here right around 103. You see, so it's probably going to oscillate in here. Just be really careful with that one. And if you have, I'd be interested to know what you actually wind up doing with it. If you want to send me an email, let me know when you're in it. And but if you do send me an email, I would really love to know where you're putting your stop. Okay. All right. Let's see. Looking at Richard says, hi, AJ. I bought MA at 150. Let me pull up MA as we're looking at this. This is MasterCard. Okay. Bought MA at 150 in 2018, sold it end of 2018 at 209. Beautiful trade right there. I'm looking for a new rebuy price in 2019. Thanks, Rich. Okay. Now, here is what I look at. First of all, this right here is called a broadening pattern. You see this? It's more or less the opposite of a pennant or a flag. All right, broadening pattern is something you got to pay very close attention to. You have higher highs while at the same time you have lower lows. Right? So the stock has been going up. You now have what's called spinning tops. Spinning tops are signs of indecision. It's kind of like a doji, but you have it on higher volume. So you get, if we're weighing the evidence here, because that's really what we do, you have to take a pad and a pencil, draw a line down the middle of the pad. On the left side, you say, okay, bearish signs. On the right side, you put bullish signs. What's going on? Well, the bearish sign is that the stock has had a long stretch of green, so it's a stale green light. That's bearish because we're due for a red. The other bearish sign is that the stochastics, both the K and the D, are overbought, over 80, and getting ready to cross. That's bearish. Another thing, you have slight resistance up here. See where this is. Aside from the broadening resistance at the top, you have that high, pretty close to that. That's bearish. You have a fairly steep angle in the leg that the stock was going up. It's greater than 45 degrees. That's bearish. Okay, what's bullish? Well, the bullish sign, and it's one of the few, is that you have an increase in volume on Friday. That's really the only bullish sign that I can see. And so if we're weighing the evidence, it's very clear that there are more bearish signals than there are bullish signals. So I would tend to shy away from this one, but I wouldn't kick it off my watch list. You see, this is one where if you look at the longer term chart, you see it has a beautiful upward trend. But notice what's happening up here. It's in trouble up here. You see this? This was a significant upward trend. And if I erase all these lines, okay, taking a step back sometimes really helps to kind of anchor in your idea. If I take this low, this is a 3-year weekly chart, right? And I connect it to this low. Actually, I'm just going to go out. I'm going to connect it just to these lows back here. Right here and here, and I'm going to extend out. And I got to keep my eye on that. The overall trend is still up, but look what could happen. This stock looks like it still has a lot of downside to it, and that could put you right back where you were in 2018 when you bought it, right around 150, 180, right there. See this? So I think this stock is actually on its way back down to test that support now that I see the weekly chart. So I would shy away from that one and look for something that's a little bit more intact with regard to the trend and not so much looking like this is a head and shoulders pattern top, because that's really what that looks like to me. It looks like a head and shoulders top that's breaking down significantly. So be careful of that one. All right, looking at the clock, we still have 15 minutes. We got a lot of time. All right, Eric. Hey, welcome, Eric. Hope you're doing well. Hope your option trading is doing amazingly well as well. AMZN. Eric is looking at that, looking for a bearish position when it reaches resistance around 1780 level. Well, I would say you can look at that right now. This is a weekly chart. Let's look at the daily chart. You've got a long stretch of green candles on that weekly chart. But lo and behold, look what you have. You have a red candle. You have a cross on the stochastics. You got resistance up here. I think I would be in line with your short idea or bearish position. And if you're, see, I'm shying away from the credit call spreads because it's capping your profit. Yeah, I think there's a high probability chance that you're going to make money by selling a credit call spread. And the premiums here, don't be confused by the spreadsheet, folks. The premiums in February are fairly high. If you look at some of the prices, the last prices are in the 50s, 40s, and such for February. I would go more with a diagonal, buying an in-the-money put on the long side, and then waiting for the stock to pull back. Because if you look at it, if you were to eyeball a Fibonacci retracement, if I went from this low to this high, the Fibonacci retracement would bring you right around here. So I think that Amazon absolutely could pull back to that level right around 1550. So if you're buying in the money puts and you wait for that pullback, you can take an enormous credit in by selling the front month out of the money put and then milk that for the next 6 to 9 months and just keep taking your credit. So I think that's a really good idea. And I don't think it would be too soon to initiate that, especially with this week looking more bearish than bullish. So hopefully I helped you out. Oh, Jeff. Hey, there we go. Just talking about you. This Jeff Sommer is the gentleman who's an old friend of mine from back in the Schwab days. He's the gentleman I was telling you is holding me accountable. Thank you, Jeff. Could you throw the fibs on the spiders, diamonds, and Qs again to see the possible pullback areas? All right, let me do that. Let me just do it on the spiders, though, Jeff, because I don't know if I'm going to have time to go through all the markets again. I did that at the beginning. But look at my pullback here. See, when I eyeballed it, I'm already eyeballing that Fibonacci retracement pullback. But let me do that for you right here. If I have the low, which I'm going from this low to the most recent high, see right there? There's the high right there. My pullback point is very, very close to the 50% retracement level on the Fibonacci fan, on the retracement scale right there. You see that? So that's again, something that I think is in order. In fact, it's kind of crazy because if you want a market to go higher, you should almost wish it to pull back a little bit to shake out any of the nervous longs. Because if the S&P pulls back like I think it will, you could attract new buyers on the long side, especially the short-term traders who are looking to trade the volatility. So again, it's something that would be in order. Because if this market continues just to go up on this angle and then hits resistance all the way up here from the highs back in September, then you could expect more of a dramatic pullback from that particular point, right? So hopefully that helped you out, Jeff. All right, Mahmoud is what would be the price target for the TVIX this week? Let's take a look. TVIX. And that's the Credit Suisse Nassau volatility. Okay, this one is crossing with a buy down here. You see this? Hopefully you can see that, Mahmoud. Now, there is it looks like there was a gap that was filled. So this is going to be a gap fill support level right here. I would expect this one, and I'm going to go, let me do it the other way around. Hold on. I'm going to go from the top to the bottom. Oh, that's the extensions. Don't want that. Hold on. Let me get my studies correct once again. Hold on. This is percent retracement. Okay, so I'm going to go here and here. It has the extensions built in. But anyway, I would say that a 50% retracement would bring that right around to 63.03. That would be a good estimate for a possible bounce on TVIX, and hopefully that helped you out. By the way, for the members who are subscribed to the Weekly Market Report, the Trade Alerts, the Option Oracle, the Equity Oracle, this recording will be archived on the member page. I just want to point that out because there were a couple of people last week that were confused, didn't know where that was. When I do these recordings, they are archived on the member page. So you don't have to take such hard notes. Mahmoud, I don't know if you're a member, but if you're not a member, then take good note of the price forecast that I made here. That would, again, bring us right around the $63 level right up here. All right. And now, if you're trading this, that you would have to put a close stop. Okay. Because, and the reason you would put a tight stop on that is because the stochastics just crossed on Friday. That's a buy signal. If it goes any lower than this, then that is a failed buy signal. You're going to have people dumping very quickly because this is going to be a volatile price action move on this one. If it drops below the most recent low right there from Friday, it could go all the way down to this low down here. You see? So it could drop to 35. So you got to keep a really tight stop on that and be careful not to ride losses if, in fact, you do get into it. All right, let me go back to my trend line. Let's go. Who's next on the list? Ken, great question here. Want to go SLV short. Okay, your target is 14 on SLV. All right, let's take a look at this. Now, remember, I'm looking to buy it, right? My idea is that SLV is going to pull back to this gap fill point. So I actually have my buy order already in. Actually, my buy order is in at 1390. It's working. So for those of you that know that already, please don't put a limit buy order at 1391 because, you know, to cut me out. I want to get filled with you as well. Put it at 1390 with me, and we get a big trader who will take us all out on the buy side. So, all right, so I'm looking for that gap to fill. The only question is, and this is what's getting in the way of my buy order, while I think it will go down to fill the gap eventually, the stochastic is already in an oversold condition. The way it looks is the volume is increasing. See this increase in volume on Friday? So I think tomorrow and Wednesday and Thursday, it will go down, but I'm not quite sure it's going to get all the way down to my buy price. So I may have to raise my limit from 1390 to somewhere up here around 14, maybe 1410. I'll be ready to go to pull the trigger because I'm sitting on cash right now and I don't want to be out of silver. I'm very happy that I sold out of it, but I don't want to stay out of it because I think that if you look at a 20-year chart of SLV, it's kind of hovering right down here in this consolidation pattern. You see it's in this trading channel right now. And eventually, I know this is a stretch, but eventually I think silver is going to get back up to $50. It's not going to happen next year. It might not happen even the year after that, but right around 2021, 2022, I'm playing this as a long-term retirement position, all right? I do think silver is going to eventually get back up to that $50 level, at which time I'll cash out my millions or maybe sell calls against my position or put it in something, you know, fixed income of some sort. I don't know. That's not all 100% of all my investable, you know, dollars, but it's part of my retirement plan. So I'm just letting you know how I trade that. All right, so hopefully that helped you out, Ken. You could short it up until the point where I stop buying it. I'll tell you what, I'll let you know when I'm buying so that you don't get hurt on the short side. That's that. All right. So, all right, Roberta, welcome. I haven't seen you on the webinars for a while. I know you've been on here before, but you said no position at present, thinking about buying Triple M. All right, here we go. 3M Corp. Now, this is the monthly chart. Notice what's happening here, Roberta. It just so happens we started off on the monthly because we left off on the monthly for SLV. I'm not very happy with what I'm seeing here for 3M because this is a significant bearish engulfing pattern right there. We have two bearish engulfing patterns back to back on the monthly chart. Keep that in mind. As we zoom in and look at the weekly chart now, this is called 3D price charting, you can see that there is also a bearish engulfing pattern from a couple of months ago. Actually, this is from the beginning of December. Bearish engulfing pattern there. We have a long stretch of green candles. What I do see, though, is I see a downward trend starting to form in 3M. You see lower highs followed by lower lows. So what I would expect, if you're thinking about buying it, you have to be a very cautious buyer. If you're going to buy it, understand that this downward trend line is going to act as resistance. Right now, you have a cross to the upside, which would help a long position on the weekly chart, but I haven't gotten to the daily chart yet. Okay, let's look at that. You still, again, resistance is up here. You have the stochastics pointing up, but it's very close to being overbought at that particular point. I should be really careful. If you do buy 3M, what I would do is I would trail your stop up, and then if it breaks out over this downward trend line, that would actually be a place where you add to your long position. So you buy on strength, you sell on weakness. So if it gets up to resistance and starts pulling back, that would be a weakness. If it breaks through resistance on high volume, that would be strength. So my big word of caution is that if you do buy it, that you put a stop price in below some of the recent lows to protect yourself. Okay, Tim, I have a couple more symbols here. Let's see, how many more folks do we have in there? Oh, we got a lot more symbols. I don't know if I'm going to get to all of them. We only have about 3 minutes left. But I'm going to go to Tim, where there is. And Tim bought SDOW last Monday, anticipating a pullback in the Dow. Let's take a look at that. SDOW. All right. Now, for this is similar to what we did, the equity Oracle subscribers last week, SPDN. We got into this one. You see, so it's almost identical in the chart, Tim. So again, I have a little bit of a bias because I'm taking the same position. All right. So if you look at SDOW, this is the Ultra Pro Dow. It's an ETF. This is inversely related to the Dow. So in other words, this goes up if the Dow drops. So I already did my analysis on the major markets. I think we are going to go lower. You got to buy cross here on stochastics. And what I'm going to be looking for is a green candle showing up tomorrow. All right, you have a long stretch of red. That's a stale red light. We're long overdue for a green. All right, I think that the forecast would be just like that. So if you get in around 16, all right, or I don't know what your cost basis is, but if you got in pretty close to these lows, I think you're in good shape to make a profit. Is that a guarantee? Of course not. So you need to put your stop somewhere below that low right there. You see that? That's the low from back on December 4th. Be really careful if it starts dropping below there. It could go a lot lower. All right, so I didn't run out of stock symbols. I just ran out of time. And I want to thank everybody. You know, this is my favorite time of the month. I get to connect with everybody. And I'm going to ask you a favor. I'm going to have to ask Kenny about this, if we could put a share button on some of these reports. I don't know if we could share this on the social media pages. But the reason I am asking everyone to share this is because to date, even though I'm not 100% accurate, I am very accurate overall in my forecasts. If we can get the general population to pay attention, at least pay attention to what we're talking about here, we're doing two good things for the general public. We're helping them focus on risk management in order to protect themselves against downside risk. But we're also creating awareness for technical analysis and how powerful it is as a tool. The more people that we have with their eyes on the charts, the more accurate the tools become. I don't care if you call it self-fulfilling prophecy or not. If you have more people reacting to a buy signal, the buy signal becomes a crisper, clearer, more accurate signal that all of us benefit from. It actually gives us an edge over the money managers who are on the professional side. You know, you have the ability to trade and get in and out of the market very quickly, whereas money managers don't have that luxury. You can buy on a buy signal, sell on a sell signal, take your profits, reinvest it in the next trade, and move on. What I'm teaching people here is not long-term investing. This is swing trading. Swing trading. It's not for the faint of heart. Obviously, you all know that by now. It is going to take some work and practice and looking at lots of charts, but hopefully you'll do it with enthusiasm and develop some sort of a passion like I do. I will never retire from what I'm doing. I love doing this. I will always do it for as long as I could walk and breathe and look at a computer monitor. I will always do this, and I'll be there for you as well. The only thing I'm asking is that you tell people about this, and maybe next session we'll have twice as many people on it as we did this week. So again, thank you so much. I'm glad you were able to join us. Have a good trading week, and I'll talk to you next time. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.